today's webinar, Association Collections and Special Assessments during COVID-19. I'm sure you as board members, we appreciate you taking the time to check in this afternoon. I'm sure you had no idea what you were getting into if you're newly elected or even in the middle of your term. These are unprecedented times. So we appreciate your leadership. A little bit about Castle quickly. Castle Group specializes in providing management services to apartments, condominiums, and HOAs in the Florida and Texas markets. We do have an office in Estero, Florida. We have about 1,700 teammates this time who are partnering with our communities. We have a full afternoon planned, a full seminar planned, if you will. And I wanted to pass over the mic, if you will, to Alessandra and Carolina. And Alessandra, if you can introduce yourself and your firm, then we'll go to Carolina and to fill in the blanks if you can.
Absolutely. Thank you, Craig. Thank you, Castle, for having us on here. My name is Alessandra Stivelman. I am a partner at Eisinger Law. I am board certified specialist in condominium and plan development. And I'm really glad to be here to be able to educate board members, property managers. Like Craig said, these are unprecedented times. There's a lot going on. Our main office is in the East Coast in Hollywood, but we represent clients throughout the state. I see a lot of repeat attendees on here, so that's fantastic. We're gonna try to cover a lot of material in a short period of time. We'll take questions as they come in to the extent it's relevant to what we're talking about. And hopefully you guys will get a lot out of this. I'm also here with Carolina Shear, who is my partner. And Carolina, do you want to say a few words?
Hi, good morning or good afternoon, everyone. Thank you so much for tuning in. I'm Carolina Shear. I'm a partner at Eisinger Brown, and I'm very happy to be able to put forward this very relevant and hot topic right now, as we have been going through this unprecedented time. Things have been developing. And now we're getting into some of the more concerning operational and financial aspects of this pandemic. Just as a disclaimer, I do it at every webinar. We're not newscasters. We're not TV producers. All this is just as new to us as it may be to you. So if there are any technical glitches, we do certainly apologize for them in advance. We're learning as we go with some of these things.
Carolina, that's a great point, and I'm going to add that as a disclaimer every time I sit in front of a camera as well. I'm a way better conference caller than Zoom caller, so I will add that disclaimer, and thank you for that lesson. Today's topic, ladies, is really relevant as we all wait to see where our kind of April collections fall. Right, we have no real issues if everybody pays their April maintenance. To put it in perspective and give you some guidance from Castle's standpoint, we ran our global AR, so that's the AR for every association we manage, January 9th and April 9th, and they were almost identical, within 1 percentage point of each other. So that is great news for April. But you're going to talk to us today about how we make sure we continue to stay on top of collections. So I'm going to turn it over to you now. I'm here to ask to provide any perspective you may want from a management standpoint, but it's on you guys, so take it away.
Thank you. Carolina, real quick before we begin, just to give you guys an overview, our presentation, we're gonna go over some of the basic collection aspects first. And I know that a lot of you guys who submitted questions in advance, a lot of it had to do with the current circumstances. So we felt it would be important to go over how it should be, and then we can discuss some of the impacts of COVID-19. So, Carolina?
Okay, here we go. So let's start from the basics and what the pertinent collection statutes are for condominiums, homeowners associations, and cooperative associations. As you know, each type of community association is governed by a different statute. So for condominiums, when we're looking at collections, we want to look at Chapter 718.116, which talks about collection assessments, liability, lien and priority, interest, and collection. For homeowners associations, you want to look at Chapter 720.308 and more importantly, Chapter 720.3085, which also talks about the assessments and charges, the payment of assessments, and the lien claims. For co-ops, you want to take a look at Chapter 719-108, which talks about the rented assessments, the liability, lien priority, interest, and collection. In all fairness, most of the statutes are virtually the same. There is a slight variation when it comes to homeowners associations, but the general framework and the general approach to collections is the same. And we'll make sure that we notate the difference for those viewers who are members of a homeowners association.
So we normally ask for a raise of hands, which we can't do now, to try to get an understanding of who's in an HOA or a condo or a co-op. If there are any of you guys that are in a co-op, if you could just let us know in the Q&A section so we have an idea. Otherwise, we'll go ahead and reference it. Going back to association ledgers, each condo, HOA, and co-op statutes reference specifically what a ledger has to contain. This is really basic stuff. Obviously, you need to have the current account with the monthly, bi-monthly, or quarterly statement, and you need to have the name of the unit owner, the due date of each assessment, and the amount paid on the account with the balance due. And that's pretty much the same for all the for the HOAs and co-ops. And I see we have about 2 co-ops here. So we'll go ahead and, we always try to include the co-ops. There's not many of you guys in South Florida, but you're still there. So we recognize you and we'll point it out to the extent that we can. Go ahead.
The reason that we want to emphasize at the beginning of this process, and Craig, I want your input here, is why we're focusing on the ledgers. The ledgers is one of the most important components of the association's collection practice. We live and die by our ledgers. If our ledgers are not correct, then we're going to have problems down the road. We're going to have a problem, and I'd like, when we get to it, for Craig to talk about how his transition team handles ledgers when you take on a new association, as an example, because that seems to be the most problematic situation that we have. But I want to emphasize to all the associations out there, especially right now, now's the time to be taking a look at your ledgers and ensuring that your ledgers are properly in order.
Yeah, I think if I could add just from our standpoint, when we transition, we understand your need to have a ledger that starts with 0 to get back to where the non-payment started. When we transition an account, it is one of the most difficult things that we make sure that we're proofing out every account that has a balance, and that can be painful. But it is something we need to do. To the extent we take over an account, we scan their ledger back to 0. So we have the prior management company stuff right away. I think the other thing we do that I think is helpful, and I know you participate in, is we give you access to the associations you represent in our system. So you can go and see right away, and if there is an issue, we can get right to those problems. So from a management standpoint, we certainly understand your need. I'm a CPA, so I understand it even better from an accounting standpoint, but we have a process that makes sure we proof out every delinquent balance should we take over an account.
So as far as a recap, these are your must-haves. You want to take a look at how your ledgers are prepared. You must have the name of the unit owner and the due date that the amount that your assessment comes in, the amount of the assessment, your interest and late fees, if applicable, and we'll talk about that in a little bit, the amount that's been paid on the account, and the balance due. Those are critical components that have to be in your ledgers.
And we talk a lot about why you need that 0 balance, and Craig referenced that. We get a lot of ledgers sometimes, and there's a carryover balance of several $1,000s, and the association can't justify that balance because it was from a prior management, and during the transition, if you're with another management company that isn't doing what Castle is doing to ensure you go back to 0, we're not able, and we may have to write off in the future. For purposes of filing a claim of lien and ensuring that the documentation is correct, we need to know when that balance started becoming due, and we need to go back to the last time that we had a 0 balance. It's really critical to ensure no issues and no challenges when we file that claim of lien, and then when we can move forward with the collection process to be able to justify the association's assessments.
Sandra, can I ask a question if I can? If the balance isn't 0 and the the board or the management company can't proof it out, do you have to write off the carry forward balance to the point that you can prove the non-payment?
I mean, generally, yes and no. I guess it depends on whether or not it's a contested foreclosure, whether or not they demand proof of the debt prior to you moving forward with the collection, and then you have to justify it. I mean, it's really important to be able to say what that amount is.
Okay.
Sometimes we can go back, and if there's a budget and we can put together based on prior payments, sometimes it's just too difficult to do that because the carryover is not significant enough where in an abundance of caution, we recommend, you know what, we don't want to deal with anyone contesting $1,000 for a delinquency that's above 10,000. It's not worth it. Let's just waive it and start from scratch, just because it will be cleaner.
Yeah.
That being said, there is a body of case law that talks about how the association maintains its records, and if the association is able to show that it maintains its records and that it, you know, upon a review of the records are accurate, there is a body of case law that would allow it. However, it's a little controversial, and if you don't feel comfortable, then in all likelihood you will have problems with it down the road when someone contests the lien amount.
Okay, thank you.
And the problem with these a lot of times come into play where you have something other than assessments on the ledger, right? So, and we'll get into, for HOAs, you can put the fine, if it's over $1,000, it's collectible, so it can be on the ledger. But when you're putting fines that are not necessarily lienable, when there's parking fees or other aspects that are mixed into the ledger and you can't justify it, so that if the owner is only contesting the fine but not the assessments, and you know, it just becomes really confusing, and you need to be able to break it down for purposes of the lien and the litigation. Okay, so we had a question, and we're gonna try to do these if they're pertinent, and then if not, I guess we'll stop at certain points. But should most associations expect to have their ledgers handled properly? Are there any instances where this doesn't happen? And the answer to that is yes, of course you should expect your association's ledgers to be handled properly. When it comes to management, you get what you pay for. So you want to make sure that you're with a good management company like Castle, who's going to have an understanding of how the ledgers are supposed to work, who's going to be able to work with you if there's any mistakes, who's going to be able to transition your ledgers properly. And there's a lot of times when ledgers are mixed up, especially during transition from management companies, or if you have different board members that are messing with it. If you're self-managed, we see that happening a lot. So, you know, you should be able to rely on a management company. You should have a management company that knows what they're doing, or whether it be a management company or an accountant, or a management company that does both. So the answer is yes, absolutely. Okay, I think we can move on.
Yes.
The next slide. I have a dog that is begging to come in.
All right, so interest and late fees. Assessment and installments on assessments that are not paid when due bear interest at the rate provided in the declaration from the date due until paid. So the first thing that an association must do when determining the interest rate is go to your declaration, generally in the area. It's going to be in the similar area after your declaration discusses how the assessments are imposed. It has a section generally that starts discussing how you collect on those assessments, when they're late, when they're delinquent, and it'll have the interest rate. If the interest rate is not mentioned, then the interest rate currently is at 18%. One thing to keep in mind, at least for our firm, it is our practice that we do not calculate the interest and add it to the ledgers. That should be done by the association, and we rely on our management companies and our association to calculate interest. Another thing that I want to stress, there's been recent discussion amongst practitioners as to whether the association is obligated to include an interest charge on its ledgers. And if it doesn't, whether one, you've waived the right to charge interest, and two, whether you're actually in violation of your obligations by failing to charge interest. So that's more of a debate issue amongst practitioners. It hasn't fully come to fruition in the courts and in the division, but Please be very careful about how you calculate interest, and if you want interest to be calculated, make sure that it's done properly. So work with your management company and their back office to be able to do that.
And just a quick note on that, I think most of the dispute has come about because the DVPR had issued fines for some associations that were not collecting interest. And, you know, just keep that in mind, but also make sure that if you're going to collect interest, you do so uniformly. You don't want, just because you have a really high balance on a unit owner that you're going after and you feel like they should be paying interest, they deserve to pay interest, but then you're not putting interest on your other ledgers. So you have to make sure you do it uniformly.
Craig, how do you guys handle interest at Castle?
We charge it as you go. It's part of the late fee processing. So when you meet your date, let's say it's the 15th of the month, we run those late fee charges, whether they're $5 or $10 or 25 or 5% of the maintenance, and then we do add interest on as we go. It's interesting at 18%, you'd be surprised how quickly the interest adds up. So to your point, it's important to get that number in the lien number, because ultimately, you know, it makes it fair for everybody.
So the other component is late fees, and this is something that most associations are not clear or misinformed about. You're only allowed to charge a late fee if your governing documents specify your ability to charge a late fee. If your governing documents say that you can charge a late fee, then the fee is either 25, the greater of 25 or 5% of each delinquent installment. So one of the things to keep in mind, and the question that has come to me in previous years, is if I have my regular assessment and that is late, and I also have a separate special assessment and that is late, do I get to charge a late fee for each assessment and then a separate late fee for the special assessment? And Ali, you've dealt with this in the past. I've had mixed reviews. Generally speaking, because the statute says on each delinquent installment for which payment is late, more aggressive collection practice is to go ahead and charge for each installment. The less aggressive obviously would just be 1 month late, $125 fee, or 5%.
Right. And this is one of the many issues where we wish we can provide a black and white answer. I mean, there's still so many undetermined issues when it comes to collections and a lot of matters of community association law. So, you know, we're giving you guys some of the issues. A lot of what the board does is based on their business judgment, how aggressive they want to be. But again, keep in mind, if you're going to be doing it and you're going to be charging 2 late fees, make sure you're doing that for everyone and not on just one specific ledger. And I think that otherwise you're opening up the possibility for selective enforcement defenses, and you're creating challenges to the lien foreclosure, and it becomes more litigated, more expensive to the association, and it really delays the process. So the cleaner you can make it and the more uniform you are with your procedures, the better off the association will be.
I have a question from Paul. Why do you rely on the association to calculate the interest? Is it a concern over possible fair debt collection claim against you? It's a very valid question. It is our firm policy to do it. One of the reasons is we don't create the ledgers, you do. So we don't want to be manipulating the ledgers on behalf of the association. You may find that other attorneys do it differently. That's our firm policy. I don't know, Ali, if you want to provide any more feedback on it, but
yeah, it's, you know, interest is not an easy calculation where we want our paralegals to be doing. You don't want to be paying attorney fees to be doing that. It's more of an accountant and management task than it is, I think, an attorney responsibility, because again, you can put in a formula on your ledger and on your program that calculates the interest like it's supposed to be calculated. If we have to go in there and do it, we're going to have to redo the entire ledger, and it is a lot of liability on us, and we have to rely on the information that's provided from the association. We can't start computing interest on everyone if historically they haven't collected interest just because now we're in foreclosure. So it's it's a choice that our firm has made. I think a lot of other association firms work like that. But it really should come from the association, in our opinion. We rely on them to keep track of the ledger. And that's why it's really important to make sure that your accountant or management company is keeping proper records.
What I would say is I would suggest we have a mixed bag. Some associations can't charge interest, obviously. Some actually in their collection policy choose to start charging when it becomes significant delinquent and goes to an attorney, and other ones just charge it every time there's a late fee. It is messy because I will tell you from a practical standpoint, from a management company, you know, the rate accrues. So it really accrues on a daily basis. So, you know, you charge an interest fee, it's 18% of $100, it's $18. You assume they're going to pay by the end of the, you know, you charge it when you send the letter. Theoretically, if they paid 10 days after that, there'd be more interest. So there gets to be some practical applications, but, you know, when it gets to collections, it's easier because they're not paying. So it's easier to calculate the interest. It's the ones that are 2 days late that it becomes an issue. And that's why some of our associations have said, you know what, we're going to charge a late fee. We'll start charging interest when it becomes a real problem.
Another question from Angela is, should late fees be broken out on the ledger? Absolutely. So the best ledgers are the ones that break it out. For example, if you have a monthly assessment, January assessment, $100. You have a special assessment, January special assessment, $100. They didn't pay on time. Late fee for January, $25. And that's how it should be itemized, so that you could you check it and you see how the fees are posted to your ledger.
And that's important too, because the statutory requirements for the claim of lien and for the demand letters and the notice of intent to lien require us to break down the late fees, the interest, and the assessment. So if it's not provided in the ledger, now we're having to try to guess what is what, and it could create disputes. So you want to try to break it down as much as possible. All right, I think we should keep going so that we get to some of the fun and juicy stuff.
And a lot of these questions are going to be answered by some of the future slides. So,
yeah.
All right, can there be any other charges on ledgers, Alessandra?
Yes, but so for HOAs, you can charge a fine of $1,000 or more if your governing documents allows is lienable. So if you get to $1,000, you put it on the ledger. There's a lot of different ways that associations handle this. Sometimes they put fines less of $1,000 on the ledger. It's not disputed. They get paid, well and done, not contested. But if we're talking about a matter that's getting to collections, then we have to clean up that ledger and ensure that only the lienable amounts can be put on that ledger. So for condominiums, you might want to put the fine in there, maybe separate it. You may want to put the parking fees, if there's additional fees that you charge for extra parking. Whatever the case may be, you can put it there so you have it in one spot, but we do recommend that you break it down in case one is contested and the other one isn't, just to make it easier for all the parties involved. And you want to be careful about trying to lien on non-lienable charges. For condos, you cannot lien on a fine, even if it's $1,000 or more. I think that covers it, right?
Yeah, I think so.
Okay, so
go ahead, Alice.
Application of payment. So this is statutory for HOAs, condos, and co-ops. Any payment received by the association must be applied in the following order: interest accrued by the association, administrative late fee, costs and reasonable attorney's fees incurred in collection, and then the delinquent assessment. This is the order of payment, notwithstanding any accord and satisfaction. It doesn't matter what they write on the check when they submit it. And that would be a restrictive endorsement, designation, or instrument placed on the payment. So a lot of times, and this used to be an issue a few years ago before the statute was amended to say that restrictive endorsements on checks don't apply. You want to be careful. We still are a little bit hesitant, even though the statute allows for it. If there is a restrictive endorsement on the check, I would run it by counsel, make sure that it's not anything that could be disputed, but this is how you apply the payments. And again, if you have a good management or a good accountant that's doing it, you shouldn't be concerned with this because they're taking care of it. You guys as board members, again, are volunteers, and we normally open up and say thank you. And I don't know that we did that this time. So thank you guys for being board members and for attending this and for increasing your education in the time of so much chaos. But you guys are not obligated to know the ins and outs of how it works, but you do need to use your business judgment and hire proper professionals that can assist you with it.
Alessandra, I think it's a good point. We get asked all the time about, my obligations as a board member and the business judgment rule, and maybe just quickly touch on that. I know we have a bunch of stuff, but that is asked all the time. Like, am I liable? Am I exposed?
Right. So, and we went into this a lot. We go into this in our board certification courses. It's something that we can probably speak about for 2 hours. But in a nutshell, board members have a fiduciary duty to act in the best interest of the association and their members. One of the major defense to a breach of fiduciary duty claim is that they utilize their business judgment. Now, you don't have to make the best decision. You don't have to make the right decision, but you have to rely on you have to use your business judgment, and that entails reaching out to the proper professionals, accountants, managers, lawyers. So if you reach out and everyone gives you the wrong answer and you rely on those wrong answers, but you still do what they advised, then 90% of the time or 99% of the times you're protected because you used your business judgment and you relied on the advice of counsel. So that's the best way.
That's excellent. That's an excellent summary.
Okay.
Let's go ahead and take a few questions and then move on, because I don't want us to go over our time. We tend to answer a lot of questions and then get kicked off at the end, like if we were in the Oscars. Are the ledger rules the same for regular assessments and special assessments? Yes, they are. You follow the same exact process. Can interest be waived in extenuating circumstances, such as a loss of job? The answer is yes, but if you are waiving for one, you have to waive for all. You cannot selectively waive. I think that should be a board decision, and we'll talk about it a little bit, particularly in light of the COVID issues. So it can happen, but you need to make sure that you're doing it in a fair manner. In the case of assessments, what be first in order? Maintenance, regular maintenance, or special assessments? I got to go back to the statutory. I believe that the, Alessandra, help me out here.
I don't know that the statute specifies it. I think you take them both as assessments, but usually you're kept in different ledgers, right? So Craig, how do you guys keep it? I'm assuming you keep the special assessments. You have a different calculation for it. So
we have different calculation, but they go on the same ledger. We treat them, our system treats them as maintenance together.
Right.
So everything else, and then it doesn't separate the charge. It's actually first in, first out from a maintenance standpoint after you get past the other stuff is the way our system does it.
Right. And I think that's the way to do it. I don't believe that the statute specifies one over the other as to how it's applied, but I think it's important to know for those that have special assessments, the special assessment funds can only be used for the specific purpose for which it is collected. So you do have to keep that in mind if you're only getting paid a certain amount and where that amount goes so that you can properly decipher it in the future.
There was a question on interest rate, whether it was 18% a month, and it's actually, the maximum rate is 18% annualized. So it gets charged at 1.5% a month.
Craig, I'm going to field this question to you because of your accounting background.
Sure.
Hold on, I just lost it.
Is that from John? For an HOA, besides being short on funds, what kind of liability exists?
It was one on interest and I couldn't, now I lost it. So I'll come back to it. I apologize.
Okay,
The interest should be calculated over the full balance or over assessments balance. No,
that's
your interest.
I believe our system, boy, this is more almost as much legal as accounting, but I believe our system charges it on maintenance fees. So we don't charge interest on, I don't believe on late fees. We don't charge interest on interest, I know. I think we might charge interest on unpaid lease fees because I think it's based on the balance. I'd actually have to go back and check.
Yeah.
So the way that I've had to calculate it before, it's a line item. So if the interest is calculated based on the assessment, the due date, how many days it's late, times the amount, and it carries forward, and then I tally it at the bottom. Right. That's how I was taught to do it. But again, I'm going to defer to management on calculation of interest.
Okay.
We tend to take the position we're lawyers. I am not good with numbers. I'm not going to pretend to be good with numbers. And so, you know, it makes no sense for associations to have us sitting there calculating these specifics, but we're happy to assist you guys with these questions. And I think this is the right answer. I don't think we can charge interest on top of interest, but everything else you can charge interest on.
I think what I would say is if you have a professional management company, we have some good competitors as well as ourselves, you know, it's all system driven. It's not like someone's sitting down calculating it. So it's all system driven. All of the systems are audited. Like we bring the CPAs in at the beginning of the year and say, okay, here's how we're doing it. Here's what it is, because they're signing off. So it's system driven. We're not throwing darts at this. It's done the same way for every association based on how it's programmed in the system, and the system programming is all overseen.
Okay, so I think this is a good time to move on because the other questions I'm seeing that are open are actually very pertinent to the next few slides.
Okay, I was gonna take one real quick, Carolina, as you're moving along. There's one here that says if a previous board did not aggressively pursue late fee and interest, now the new board is trying to collect late fees and interest, what should you do? And this goes for collections, but generally anything else, if you come on the board and you realize the prior board wasn't doing it correctly or pursuant to the law, you're gonna have to, depending on the circumstances, grandfather in the past, pass a resolution, and advise everyone that moving forward, you're going to be complying with the requirements of the law and the governing documents. But this is an issue because now you're going to have a ledger, and sometimes interest is being charged and other times it's not. So you're going to have to work with your attorneys and with your management to see what makes the most sense for your specific association. How old are these delinquencies where it wasn't done correctly? Where are you on the collection process? Can you start now? I mean, these are situations that really have to be addressed based on the details.
I think that's a good segue into the actual collection process. What we want to keep in mind is that a unit owner, regardless of how they acquire the title, is liable for all of the assessments that come due while they are in possession of the unit. The owners, with some exception, which we'll talk about, the owners are jointly and severally liable with the previous owner. So this is why we have the whole process, estoppel process of, that takes place when units get sold, to make sure that the prior owner has a zero balance and that the unit owner starts out with a zero balance. This is becoming a very topical question. Liability for rents and assessments cannot be avoided by waiver of use and enjoyment of the common areas or common elements or abandonment of the unit. So we're having a lot of COVID related questions coming in saying, well, you know, you closed down my pool, you closed down my gym, so I shouldn't have to pay you for my assessments because I don't get to use the property. Likewise, what we're getting is tenants calling in to their landlord saying, I can't use the amenities, so I should get a discount on my rent. And then the unit owner calls us and says, my tenant wants a discount on their rent, so you guys should give me a discount on my assessments. Unfortunately, it doesn't work like that. One thing has nothing to do with the other, and just because we are under a pandemic and we've been ordered to shut down our amenities does not waive or preclude a unit owner from having to pay for their assessments.
One thing to keep in mind, oh, sorry, real quick, Greg, is that, you know, you may not be allowing individuals to use your pool, but you still need to have that pool maintained. You don't want it turning green and becoming a liability and a safety hazard. So even though because of COVID-19, we're having to shut down certain amenities, there may still be expenses, and there likely are still expenses associated with it. Even though you can't use the gym, you may have a contract, or maybe the equipment is leased and you're still having to pay the lease for the equipment. So you have to keep that in mind, that it's not just because it's closed, the association isn't incurring expenses as a result of it.
In fact, they may incur expenses that you didn't expect you'd have, you know, extra cleaning of facilities, you know, fogging of common areas, that type of thing. I will just on the issue of collections, what we've seen and what we're recommending is, especially in April, it's business as usual. It's collections as usual. You know, we've been through this before. If we're going to see we're not seeing a huge issue yet in April. So, you know, be empathetic to your residents, be careful about blanket statements, and, you know, collect like you normally would until something dramatic happens on the collection side.
Okay, let's keep
All
going.
right, so here's a popular question. When is the assessment due or special assessment due? When is it late and when is it delinquent? And that's all very important because we need to know this is what triggers, in essence, what your policy is going to be for sending it to collections, for imposing the late fines and the interest. In general, your declaration of condominium is, or your homeowners association covenants or your co-op documents are going to indicate when your assessments are due. That's the date that they are due. Some documents will say they're due on this date and considered late 5 days from now. So that's when you're late. And that, I'm sorry, but that causes like a management nightmare.
That is a nightmare.
Yeah, we hate it, but it is what it is, and we have to live by it. So let's say your documents are these fabulous documents that say it's due on the 1st, but considered late on the 10th. So everybody has to pay on the 1st, and after the 10th, that's when your association gets to put in their late fee and start charging interest. Practically speaking, what I see happening is everyone sees it's due on the 1st, but late on the 10th, everyone's paying on the 9th, and that creates a problem. When is a special assessment? This is slightly different. The special assessment, when you have your special assessment meeting, one of the factors that needs to be, the special assessment will be levied on the date of the meeting, but you will indicate when the special assessment is due. So it's usually either going to be that if you're levying a special assessment in one lump sum, it's due, let's say 30 days from the date that you levied it. Or if you're doing an installment situation, it will be the special assessment installment will be due as per what the special assessment instructions are.
And we had a question about this, which I typed the answer to, but just to elaborate on what you're saying, this is why it's really important for boards. When you pass a special assessment, you have to determine if it's going to be due at a specific date or if you're going to allow installments and if you're going to impose a due on sale clause. Some associations, declarations have that in their documents. Others are adopted by the board, and I'm not sure as to the legality of it. It's controversial, but it needs to be specified when the special assessment is adopted as to what's going to happen if it's installments and then they sell the property halfway in. And what's going to happen if it's not, if you're giving the option. Some people may choose installments. Some people may choose to pay it in less installments. How do you calculate the interest? I mean, there's so many details that go into this. So it needs to be all thought of ahead of time so that you can make sure that you put all that information in your notice when it goes out and the meeting notice when you adopt those, or the meeting minutes when the special assessment gets adopted. Can
I make a comment on that one? Because I think it's a great point. We do get a lot of controversy on what happens when I sell, and we keep pointing people back. You know, this is a discussion we have to have with your attorney to make sure the notice is proper. That's why we want to bounce all special assessment notices back against you guys. The other thing I would ask you to comment on in the collection world, the acceleration of either maintenance or special assessment payments. So someone's gone to collection, there's an outstanding special assessment with 10 more payments. Can you comment on the escalation provisions and how you make that happen?
Yeah, so in my experience, it's been rarely done, and generally it's when you have to have the authority to do so in your governing documents. And I've seen other attorneys do that, but it's not something that we normally do. I think it gets complicated, and again, it opens up the association. If you're not going to get paid anyway and you're going to take title to the property, what does it matter if you accelerated it? Because it's going to just give them an option to challenge it. But again, it's a case by case because you have to see the type of individual that's being foreclosed, whether they're going to be litigious or whether you believe that they're going to pay or not. And again, you have to do it uniformly while taking it into a case by case basis. So I feel like a broken record because I'm saying do everything to everyone the same way, but at the same time, case by case basis. It depends.
Fair. Okay. Well, I just wanted to throw that out there.
There's one other consideration with acceleration of payments, particularly if we're going to see an uptick in mortgage foreclosures, because, and we'll talk about safe harbor briefly a little bit later, but if you accelerate the assessments and then the property lingers in foreclosure or lingers in association foreclosure, you may have a problem with your safe harbor, and you may end up losing out more than necessary.
Thank you.
Okay, so all of this is pretty much summed up in everyone right now should be reviewing their collections policy. If you don't have a collections policy, you should be adopting a collections policy. The meat and potatoes of the collection policy is what and when should notices and reminders be sent by the association, when the delinquent account should be sent to the attorney, who signs the liens, the policy on the payment plans, waiver on late fees or interest, consideration of tenant collections, and making sure that there's no selective enforcement. Now, from a managerial standpoint, I've seen a proposed resolution that Castle generally shares with their associations and lays out the groundwork of how the policy should be done, and then the board by resolution adopts that policy. Obviously, it should be in line with the association's governing documents. That's a very good starting point. Another point that I want to make, and this is a discussion that I have with many of my associations, when should delinquent accounts be sent to the attorney? And the reason this is very important is I have some associations that say, well, we don't send delinquent accounts until they're delinquent for 3 months. Okay. So at the 90-day mark, you're starting to send this to an attorney. That's 90 days. The attorney, and I'll talk about this a little bit further later, then has to send the initial 30-day demand. We're now at 120 days. After the initial demand, you have 30 days to record the lien. We're now 100. I'm not a mathematician. 120 plus 30 is 150. Okay. So, and then you have to file a lawsuit 30 days after that, essentially. So you are now looking at 6 months of assessments that you have not collected because of that 3-month policy.
And what you're saying is for condos and co-ops, remember, HOAs are 45 days. So it's even longer with that demand letter and intent to lien.
Mm-hmm.
So all I'm saying, the takeaway from this is you want to look at your policy. You might want to tighten it up because you're essentially losing on an opportunity to collect.
And bringing it back to what we're dealing with now is that we know that a lot of mortgages are stayed. And there's a lot of leeway for owners to pay their mortgages during the COVID-19 crisis. And I believe certain mortgages up to a year. We don't believe that that applies to associations, which means that this is the association's opportunity to get ahead of the game. If you have a bank foreclosure that's going on, I believe that those get stayed. Carolina, correct me if I'm wrong.
Right now, yes. Right now, in the state of Florida, mortgage foreclosure actions are being stayed. Sales are not being, all sales were canceled until further notice. Writs of possession are not being issued. And in many jurisdictions, they're not even entering defaults, nor can you get a hearing to get a final judgment. So right now it's at a standstill.
And there's a lot of controversy as to whether or not the executive orders apply to associations or not. Our position is that they don't, based on the way it's written. However, I know that some counties and some jurisdictions, the judges are just not allowing those foreclosure sales date to be set. Others are. Either way, whether you get the foreclosure date and you take possession and you're still ahead of the bank, or at least you're set up to do that as soon as you can, you're going to be in a better position. So the main message here is don't wait, don't delay. Obviously, we'll talk about some maybe changes in policies that you may want to consider during the crisis, but at the same time, you don't want to just waive delinquencies at this point or not send them to collections because it's going to put you so far behind and you're going to have issues operating moving forward. Okay. Do we want to take some questions or what's the, oh, perfect.
Well, that is it's our time.
Okay.
Okay,
So
start.
There's some great questions, actually. Let me point a few that I get asked all the time. We're in the middle of a special assessment where our owners are making installment payments. The project stopped. Can I or how do I stop the payments to give our owners a break?
And this is, I think, one of my clients. So
he wants the advice free. That's why he's asking now.
At least a similar one. So generally, if you're doing a project and you pass a special assessment, there's also a loan to be considered, right? A loan to the bank. And I would not stop the special assessment. I think the association has an obligation to continue to collect it. and you can enter into payment plans to the extent necessary, and that would be on a case-by-case basis or based on your policy with consideration for certain circumstances. I think we have to remember that there are people that have been delinquent that were delinquent before the COVID-19 crisis. Then there are those that became delinquent because of the COVID-19 crisis. And I think it's fair that we treat those differently to a certain extent. At the same time, if you stop, it becomes a miscommunication. I don't think the bank will allow you to stop collections unless there is an executive order that allows you to stop collecting the special assessment, because you need to maintain a certain amount in your account if you have a loan for the construction project. So there's a lot of different elements at place, but I think overall, and Carolina, Craig, feel free to jump in, but I would not recommend to stop collecting those special assessments, even if the project stops.
You have to continue operating your association under as normal circumstances as possible. One thing that we may, and I was having this discussion yesterday, one thing that many of us learned from the last financial crisis is some associations went very strong on collections. Some associations cut all services, maintenance and projects. Those associations that tended to be much more aggressive on collections came out of it in a better financial shape than those associations that merely cut their budgets, cut their projects, cut their maintenance, because now we're about 10 years down the road, they're paying for the lack of maintenance, lack of projects, and they're paying dearly for the option that they chose, and maybe they didn't have much of an option back then, but that's what happened. So my personal opinion is that you should continue with normal operations of the association. You should certainly not undertake new projects right now, but if they were pre-planned, pre-assessed, continue your normal operations as much as you can, as much as you're permitted to.
And I mean, remember, for different associations, the process to impose a special assessment may require unit owner approval. So now if you're stopping it and then restarting it, it becomes a procedural nightmare for the accounting standpoint as well. So as Carolina said, you want to keep with the regular operations. We had another question here. A resident mails their late check, they get a late fee and admin fee added to the account. We waive the fees as long as the resident goes on auto pay. Is that legal? Carolina, what are your thoughts on that? Oh, she's getting up. Okay, so I think she left, so I'll answer that. I think as long as you have that in your policy, you don't want to just be waiving late fees and interest fees, because then someone can come back and challenge that you're not enforcing the governing documents. We mentioned that in the beginning that the DVPR has come down on some associations that haven't collected interest. So, if you're doing it as a policy and there is some consideration for, okay, well, if you go in auto pay and it's not going to be late again, then we'll agree to waive this one time, then I don't have a problem with it. Craig, I don't know how you guys normally handle that.
You see that a lot, where boards will give us the authority to waive it one time if someone signs up for auto pay. It makes a lot of sense. It isn't a privilege granted to somebody who's routinely late. It's kind of a one-time shot, and getting them on auto pay is a huge simplification for everybody. Management company, board of directors, it smooths the cash flow. So we have most associations are accommodating with respect to one write-off in return for signing up for auto pay, which is the direct payment, an association initiated payment of the maintenance fees from your account.
Let's go ahead and just move on a little bit through the information so that we can reserve some time at the end for questions. The lien process. The association has a lien on each unit or lot to secure of assessments. The lien is effective, and now this does tend to be somewhat document intensive under certain circumstances, but the lien is effective from and relates back to the original recording of the declaration. And as to first mortgages, the lien is effective from the time that you record the lien in the public records. There is some caveat. Speak with your attorney about your particular circumstances on the effectiveness of your lien, depending on your governing documents. The intent to lien is the first requirement. So did I go too far? No. Okay, so we're going to talk about the intent to lien. A lien's not effective
Wait, did you do the demand letter?
That's that. I think there might be a glitch in the slide.
Hold on, let me look over here. Sorry about that, guys.
Okay, so let's talk about the demand letter, or what we refer to as the intent to lien. The intent to lien has to be mailed out at least 30 days prior to the time that you record the lien. So this is what we call the demand letter, the first lawyer letter, and it says, "Dear John Doe, you're delinquent." Obviously, it follows a format, but it shows the amount that you are delinquent, and it says, "You must pay this amount, and if you don't, pursuant to the governing documents of Florida statute, we are going to be filing a lien." Okay.
Now, most of the times, just to give you guys an understanding, there's some very specific statutory language that needs to go into those letters. So even if management has already sent a violation letter or a delinquency letter, or if the board has done it, we're still going to do it again 99% of the times to ensure that we're not going to have an issue moving forward.
Yeah, if I could, from a practical standpoint, we send a reminder and a default letter, and we don't get involved at all in the, like, you guys are the pros. We don't want to, get into any of the collection side, if you will. So
right.
When we turn it over to you, it's pretty clean from that side. And I know some management companies do. We've chosen not to get involved in that. That's your expertise.
Right, and we like that because then we don't have to fix mix-ups and deal with clients that don't understand why we're redoing something that was already done, but it wasn't done correctly. So you guys do your violation and your delinquency, and then when it comes to us, we start from that intent to lien letter.
Right.
Okay, so we've sent our initial intent to lien letter. The unit owner does not pay in time. What's the next step? The next step is the filing of the lien and the intent to foreclose. So let's talk about the lien, because the lien is the most hotly contested item in any collections proceeding. There are specific statutory requirements that must be contained in the lien, including the description of the parcel, the name of the record owner, the name and address of the association, the amount due, and the biggest one of all, the due dates, because this is the one that has the most objections when we see foreclosure actions being filed and challenged. This is another one that I've litigated on a few occasions that's somewhat novel. The lien has to be executed and acknowledged by an officer or authorized agent of the association. The reason that this is important is there are a few documents out there that have a slightly different variation on the requirement to sign the liens. A lot of the times the associations adopt resolutions allowing your manager to sign the liens, or they adopt a resolution allowing your association attorney to sign the liens, but there are a few documents that require that the lien be actually signed by an officer or authorized officer. So you have to be very careful about what your governing documents say and make sure that your lien is not otherwise invalidated over a technicality.
So once you file your lien, you send the intent to foreclose letter. And that is what we call the second letter. And that's essentially, it attaches a copy of the lien that's already been recorded in the public records. And it says, if you don't pay within 30 days for condo and co-ops or 45 days for HOAs, then we're going to begin a foreclosure suit against you. And there are, again, specific requirements, which we list here. There's a statutory form that we need to use. We need to break it down. You need to have the total amount due with interest and any costs. It needs to be provided by certified mail, return receipt requested. And if the procedure is not followed, the association forfeits its right to collect attorney's fees. So that's really important.
All right, last but not least, once that is done and the person does not pay, then the next process is to commence the foreclosure process, which follows the similar concept of mortgage foreclosures. Depending on your jurisdiction, they might be treated differently as far as what division they go in. But general process, your attorney is going to handle your foreclosure process all the way up to judgment. And at the judgment standpoint, the property will go to auction. I think most of the auctions right now in Florida are online auctions where the association's minimum bid is going to be what the judgment amount is. If an individual pays that judgment amount, they get title to the property. If you don't meet your bid amount, then the association would in essence be awarded title to the property.
Okay, I think we need to speed up so we get to answer all of these. There are other options other than foreclosure. You can suspend use rights, voting rights, deny the right to lease if they're delinquent, or send a letter to the tenant to collect from the tenant. sorry, next slide. I'm just trying to speed up through all of these.
We talked about this a little bit. It's called safe harbor. This is to keep in consideration because your first mortgage or successors under the statute, they may be in, if they acquire title to a foreclosure or a deed in lieu, their obligation is either going to be 12 months of unpaid assessments or 1% of the mortgage debt. Now, this is very important because your governing documents control whether this applies and whether you have any ability to collect any money from a first mortgage.
And that's where Kaufman Language comes in. We can, just in a layman's terms, you need to look at your documents and see if they define the act, whether it be Chapter 720 or Chapter 718, as of the date it exists when your declaration was recorded, or if it's as amended from time to time. That's going to tell you whether or not the statute applies to your governing documents based on when your documents were recorded and what remedies you may have. And if you haven't looked at this, this is something that we highly recommend. Reach out to your attorneys and address this issue, because you may be foreclosing and then the bank starts foreclosure and you may be entitled to nothing if you don't have the appropriate language in your governing documents.
Another concept that I really want to touch upon is fair debt collections concerns. We keep advocating or saying you should be aggressive collections process, but there is a limit to how aggressive you can be. You cannot violate Florida and federal Fair Debt Collection Practices Act in your aggressiveness. I have associations who have resorted to creative methods, shutting people's electricity off, denying them parking, shaming policies where you post like a list of shamed individuals. Those tactics could be deemed violations of fair debt collection under the Florida or federal statute. So I would caution you to speak to your attorney before you want to resort to any creative collection policies.
Carolina, I have a suggestion. Most of the questions that we have are regarding COVID-19. We have a few slides on special assessment, reserves, and loans. I think that maybe we should let them be and then just go to the impact of our current pandemic on collections.
Agree.
Is that okay?
I think, yeah, guys, again, we're not newscasters, so the timing's a little bit off and we've had great participation. So let's go ahead and do that. We'd be happy to share the slides with you and answer any other questions you may have on the slides.
Okay, so moving on to Carolina, if you want to move on to, I think it's slide 34.
Got it.
Okay. So you guys may have heard this. I know that Castle and our firm and a lot of different firms have been doing different webinars on COVID-19 and the pandemic and how it's affecting associations. It all started with, we know there are emergency powers in the statutes, but the statute was drafted in such a way that would lead us to believe that it applies to hurricanes or damages. I think it was last week, Friday evening, the DVPR issued an order that determined that certain powers did apply and was completely silent on other powers. It said that you can modify meetings, you can close up your property, you have to notice needs to be practical, but the two emergency powers regarding the passage of special assessment and the ability to take out a loan were specifically not addressed. We're not sure if that was purpose, we're not sure if that's coming, but the reality is that right now, you should probably not be utilizing the power to specially assess without unit owner approval unless your documents allow it. You still need to go through the approval requirements in your governing documents for taking out a loan, and that includes the SBA loan, or if the association qualifies, and that's debatable under the paycheck, the CARES Act, I believe. Yeah.
Can I make a comment? If I can make a comment on this one, you know, what we're advising and working with our boards doing is take a breath. Because with respect to your cash and collections and special assessment and emergency borrowings, you know, most associations are well prepared. They're well funded. You know, a lot collect maintenance quarterly. They're not going to have an issue if they do a good job in April. They're not really going to have a problem until June when that next quarterly payment is done, and God willing, we'll be through this process. So we're saying take stock, figure out what surplus you have, determine what impact your collections are going to have, because this problem is, from a cash business standpoint and needing to special assess and needing to borrow, goes away if you collect your maintenance. So let's see where we end up after April. That's what we're advocating. And then you have other sources. You can use surplus. There are already built into the statute ways you can access your reserve funds as an HOA in a condo. And you're not doing any of this without talking to your attorney, but there are things we can do to weather the storm. And then, you know, most association documents provide for how to borrow money. And I can tell you that what's in your documents is way faster than dealing with the SBA at this point in time. So, you know, work with your management company, do the financial inventory of where you stand, see what the timeline looks like if you have a problem. The payroll protection plan loans under CARES don't appear to be accessible by associations. We get a lot of those questions. Some are applying. We have several associations applying just to see, because you never know the difference between what the rules say and what the SBA approves. The emergency disaster loans, they have a long life. You don't have to apply for them until the end of the year. They require you to proof losses, which you haven't incurred yet. So I guess to summarize, take a deep breath, take inventory of where you are with your, you know, CPA or accountant or management company, determine what you need to do, and don't panic. There are procedures in place, and you probably don't need an emergency special assessment tomorrow, because emergency special assessment, the reason you would need one is people aren't paying. So to assess people who aren't paying is it's an oxymoron. Like, it doesn't make a whole bunch of sense. So that's kind of what we're advocating for our team.
And I think that's really sound advice. There's been a lot of really, what's a proper word? People are acting without really thinking out the consequences. Boards are taking very drastic actions, reducing assessments, redoing their budget because the amenities are closed and the unit owners are upset. So they decide, well, I guess since we're not spending on this, we'll adopt an adopted budget, or we'll have them vote to use reserve funds. That's not necessary now. If you want to be proactive, meet with your accountant and management company. Also, if you don't have electronic voting in place, maybe now is a time to get that set up, so that if you do come into an emergency situation later where you have to take a vote to use special assessments or reserves for a different purpose, and you need the owners to participate, you have that established, you have people signed up. Now is the time to kind of look at the bigger picture and not take drastic action.
I would agree 100%. Ladies, listen, we're winding down on our time. We want to be respectful of all of those board members and et cetera that dialed in or webinared in this afternoon. So I want to thank you and ask you if you have any kind of parting advice for our board members. I would say, Alessandra, to pivot on your comment before, thank you for what you do, board members. It's a thankless job in the best of times. Now you're shutting down amenities and you're taking things away from people that they expect. So we appreciate your leadership in this tough time. And I'll ask you for any parting comments. Alessandra, let's start with you.
So what I've been telling a lot of our clients is communication is key here. Make sure you communicate with your membership. A lot of the disgruntled owners, the owners become disgruntled when they get surprised. Things are closed, they don't know, there's stuff going on, all of a sudden there's emergency action. Communicate with them, send the emails, everyone's glued to their computers. And just keep in mind that, and I know there's a lot of questions that we didn't answer, and I'm sorry, they're all really good, and most of them relate to waiving of assessment, late fees and interest during this time. Reach out to your attorney and your management company. Come up with a plan. It's going to depend on your association, your financial status, the type of community that you are, and the type of owners that you have. It needs to be decided on a case-by-case basis for your community, and then apply uniformly to all the owners.
Carolina, any parting comments from you?
No, again, look at your policy. This is the time. I relate this to when we are embarking in the new hurricane season, where everybody says the time to prepare is now, before the hurricane comes into the cone of uncertainty. This is a time, I'm going to copy what the newscasters say. This is the time to prepare. The time is now. The time to shelter in place is now. Look at your policy. Look at what needs to be tweaked. If you need to have a meeting, have the meeting, establish the policy, establish the resolution, and put all the measures in place. Now is the time before the eye of the storm hits Florida.
I think that's sage advice. For our participants, we have a couple of questions. Can you get the slides? You can email, what do you have, info@castlegroup.com, and we'll make sure that we get the slides out to you. That's okay. I've pre-cleared that, so we're happy to get that stuff out to you. And I would part by saying, again, thank you. Utilize your professionals. You're not in this alone. You have great attorneys. You have great management companies. You have good CPAs that can walk you through this process. So thank you, everybody, very much. Be safe and healthy, and we'll see you next time. Take care.
Thank you.
Bye.